Welcome to Phil's Gang YouTube channel. They're talking about the interest rate going to go up in December. I want to explain to you what will happen if they go up and why we're going to get QE4 and why we should get another surge in the stock market. But to understand that, first let's go back. Here's our first bubble. This is the tech bubble. It collapsed. Here's our second bubble, the housing and finance bubble. It collapsed. This is when we started our QE bubble, QE 1, 2, and 3, from 2009 up to 2012, and we stopped. Now, we should have collapsed. All bubbles are the same. And they all collapse when they reach a point that there is no more demand, and then prices drop, deflation hits, people get laid off, and you get the crash. They all do the same thing. What they did this time differently, they came in with a Ponzi scheme, an accounting scheme of stock buybacks. Here's how it works. What they do is make sure that the dollar continues to get stronger. How do they do that? Well, Yellen will keep telling people around the world that our economy is so good that we're going to raise our interest rates. Raising an interest rate is synonymous with a good economy. People from all over the world look to the United States for leadership, and they look as the safest place to invest, especially the Europeans. So every time she opens her mouth and says that we're going to have our interest rate hike, she doesn't mean it. It takes the dollar and moves the dollar even higher. Now, what does that do to our companies? Well, that's a problem, because our companies, what happens to them, their earnings, because the dollar's strong, they can't sell their stuff overseas. 70 to 75% of all our S&P 500 companies, most of their earnings, about 75% of their earnings, come from overseas. When you have a strong dollar, you can't compete with the euro. So our sales drop, earnings drop, the stock price drops. To stop that from happening, they came up with a great Ponzi scheme. A small segment of a population, about the 5 percentile, they control 85% of the stock market. What they said is, let's print money, and they take the printing machine. Let's print money, and let's take that money, and let's fund all the companies. Let's fund all the companies money at 0%. So what they did is just that. They took, and they got their little printing machine going, and they kept feeding these companies. They would feed them money at zero interest. They would keep pushing this money into the company. So they would buy their stock back, and their company stock would turn and go back up. Because all they would do is they buying their stock back. When a company has less shares, that means they are taking their profits, spreading over fewer shares. That push up their earnings and push their stock price back up. Not sustainable, all fake, no value for the company. Sure, a lot of value for the CEOs because they got stock options and the board of directors. And that's the Ponzi scheme. And that's why we've been staying at 0% interest so long, because that keeps the stock market going up instead of falling as it did here in QE1. In Bubble 1, Bubble 2. That's why we haven't had a 10% correction since 2011. Believe that? Because of this Ponzi scheme of printing zero money. So they continue to make the stock market, make the dollar go up through saying they're going to raise rates when they don't. The dollar even gets stronger, because if the dollar goes up, that means our deficits get reduced. Our trade deficit gets reduced. It makes the dollar even stronger again. And that means the companies keep getting hit. So as long as the companies keep getting hit, and that's what everybody wants, the big money, the 5 percentile, who have most of their money in the stock market. Remember, most people on Main Street, most of their wealth is in fixed income, not the stock market. Wall Street, remember, their wealth is all in stocks. So the idea is to keep making the dollar go up, press down the earnings of the companies, so they got the excuse to keep money at zero, to give it to the companies at zero, so they buy their stock back and push up the market. And here's how it keeps going. This is what's been going on. We should have collapsed right here. It should have been just like these. But that's what's going on. So now, what's going to happen if they raise rates? There's no more zero rates. Well, that's going to be a problem. If they stop the zero and they're not giving companies money anymore to buy their own shares back, then their earnings and their stock price is going to start coming down. And it's going to be reflective right here. It's going to start coming down like this. We're stuck right now in this market because they're not sure what to do yet because we're getting close to December. So it will start coming down. We haven't had a 10% correction since 2011. They're going to stop this. Well, how? More stock buybacks? No. They're going to go back to QE. So they did QE 1, 2, 3. They're going to come in here with QE4. Now, what's QE4? What do they do? Well, you have the 10-year Treasury at 2.3%. Saudis, Chinese, they're our biggest buyers of these 10-year Treasury. They love it. Germany, France, everybody comes and buys our debt, buys our Treasury. They love having a return of 2.3% for 10 years. So they'll print more money, like they did here in 1 and 2, and that's how they got this stock market to go up. Because what they do is the Fed will print money, come in, buy all the bonds, 10-year Treasuries, drop it down to 1.1 from 2.3 to make it so unattractive that all the Chinese and everybody who are buying bonds now will come in here and switch. It will force them to buy stocks right here, just like it did here. That's what, because remember, QE1, 2, and 3, they were buying every month $85 billion worth of 10-year Treasuries to make them drop the yield down. And everybody went into the stock market, and that's what moved the market up here. Then when they took it away in 2012, the market started to pull back. See it right here? It started to pull back. Then they decided the scheme of stock buybacks, an accounting trick, and that's what they've been doing. So if we pull back, we may get a little pullback because I don't think they'll just come and do QE when they stop the zero. If they do raise rates in December, I don't think they're going to just immediately do QE4. But with a pullback, they will. And then they'll do the same thing again as they did right here, where they bought all the bonds, $85 billion a month, to force everybody into the stock market. That's what they're going to do again. And then we'll continue on our way. So we may have a little dip, but they'll come back in with QE and we're on our way. Now, how far can we go? Well, here's the problem. Every crash has the same problem. They reach a point where you keep on hurting the economy. The more money you print to buy bonds, to drop the yields down, or the more money you print to provide 0% money to corporations to buy their own stock to push their stock prices back up, that hurts everybody because the dollar gets weaker and weaker. That means that people go into the supermarket, they have to pay more for food, pay more for everything. The zero interest means people aren't saving. And if you don't have savings over here, there's no investment. If there's no investment, we can't grow jobs. So when there's no savings, when you're getting zero interest on your savings book or 0.25%, nobody saves. That means companies are not out buying new equipment. They're not expanding. They're not hiring people, and it kills the economy. And that's what's been going on because the economy, we've been at 1.9% through this whole rally. We've been at 1 point, we don't grow. There's the real problem. So it gets to a point, the more they do this, the more they keep printing money, the more they keep hurting the economy. And just at some point, people just can't buy anymore. And that's what happened here with the tech. Demand stopped, prices drop, people get laid off, and you go into a recession. Same thing here. Demand stopped with housing. No more demand for housing. People just didn't have any money because they were all tapped out. They had to start. Everybody was tapped out. Demand stopped. People got laid off. Market dropped. So that's what's going to happen. It should have happened right here. We're right here right now. It should be happening right here. because the economy is getting worse and worse and worse every day because of the 0% financing, because there's no investment in companies. Companies aren't expanding. So it should have happened, but they're not letting it happen. Why? Because the 5 percentile of this country, all of their wealth is tied to the stock market. And they're the ones who control a little company called the Federal Reserve, a banking syndicate. So they're going to do everything they can to keep the market going up, and why they'll do QE4. And this will stop the same way as it did here, and will come down. Eventually it'll stop, same thing. The economy is so destroyed by a few people are making a lot of money that demand stops. The only thing that's keeping this country going is auto sales and student loans. That's it. And once those auto sales stop, demand stops, and it's over. And that means we start coming back down again. But that could be another year or two. We could get another 100% rally, 160%. We could go up just like this year. We had 100%, 160% rally so far. We've gone up 160%. And isn't that a shame? People got out of the market. They had no idea what was going on, that there was no way for this market to drop. As long as they're doing this 0% finance, doing QE1, 2, and 3, and then turn to stock buybacks. And now we do it. Now all you got to wait for, if they don't raise rates, we're just going to continue to go up. We'll break out and continue to go up. If they do raise rates, we'll drop back. We'll make money shorting, and then we'll go back up through QE4. I hope this explains now, and you understand better how this Ponzi scheme works and why it's ridiculous that people say, I'm going to stay away from the market. It's rigged. It's always rigged to the upside. Look at the money you didn't make. Instead, you went into bonds. And here's the problem with the bonds. Once they raise rates, the people who are in bonds are going to get their face ripped off. See you on the charts. Join my gang, Phil's gang. And before I leave, I want to remind you one thing right here. I have a simple chart. It's called the PT2. When it turns green, you buy. When it turns red, you sell short. This always works. This is one of our stocks, Schlumberger, right here. We buy on green and we sell on red. Nothing better. We're shorting right now, right here. See, it just turned red. Please join my gang. Check it out, philsgang.com.